we get into how markets did and our model portfolios and how they're performing. Okay, so we'll start in Canada. I'll start with the indexes. I'll start with the benchmarks, if you will, and then I'll speak about how the Tower models performed in comparison. So the S&P TSX, that's the Toronto Stock Exchange, down 11.1% year to date. The S&P 500, that's in the States, down 23.9%. The NASDAQ, this is also the States, but this is more tech companies, down 32.4%. And I also wanted to highlight, because we talked about bonds. This is a bond exchange traded fund, a bond ETF. It's a core Canadian universe bond, just a broad-based bond fund, down 11.9%, nearly 12% for the year, right? So all of these benchmarks are down for the year. So we'll talk about how the Tower portfolios have done. So I want to emphasize as well, these are actual returns and actual client accounts. This is not based on a sort of back-tested model or anything like that. So our enhanced index aggressive growth model is down 9.6% for the year. Growth is down 9.6%. Our balanced is down 9.8%, and the conservative is down 9.9%. And the reason the balance and the conservative are actually down a little bit more is because they're overexposure, they're additional exposure to bonds like we spoke to before. But I do want to point out that all those portfolios, a good benchmark would be a combination of the TSX, the S&P 500, and the bond fund that I mentioned. And those portfolios have outperformed every single one of them. And so they have exposure to all those markets and have outperformed every single one of them, which is good. And the final portfolio I want to point to is our Canadian momentum portfolio. Now, our goal in this one, again, is to beat the Toronto Stock Exchange. And year to date, up to the end of September, the portfolio is actually up 1.37%, which is a solid 12.5% outperformance of the Toronto Stock Exchange year to date. So we're really, really happy with how the momentum strategy has performed in the first 9 months of the year, the first 3 quarters of the year. So, okay. As much as, go ahead.
Okay, so let me ask the question, Tarek. Mm-hmm. What is it about our portfolios that has caused them, every one of them, to outperform? I'm surprised at how close they're all to each other. Mm-hmm. They're actually quite different asset mixes. Maybe comment on those two things. Why are they all so close to each other? Are you surprised at that? And then number two, what are we doing that has caused our index funds to outperform? And even more, what are we doing that has caused our momentum fund to outperform?
Good questions. So in my opinion, the reason our enhanced index portfolios are outperforming is because we invest in fundamental weighted indexes from around the world. So as I was saying earlier, this Fed tightening, interest rate increasing environment has led to some challenges for a lot of companies in the market, but in fundamental indexes here to companies that are stronger and better prepared to deal with this. And I think as we continue to go forward, we'll continue to see outperformance because of those fundamental indexes.
Okay, on that one, I'll add this. I believe that means that on a rebound, once the economy sort of moves out of this tightening inflationary, area, it's the strong companies that will actually do the better rebound, I think, right?
Exactly.
Okay. Now you're going to go to momentum. What are we doing there that's caused it to be up when the whole market's down?
Well, as we've said with momentum, if you've heard Mark and I talk about it before, it's a very mathematical strategy. It's quantitative, and we don't spend a lot of time tinkering. And I think that's really valuable because we built this strategy intentionally to follow, a formula, and it's mathematical. And we followed that formula. And because of the quarterly rebalancing, we were able to, I think, to pivot to the bright spots as things were, changing over the last 9 months. We were able to say in a quarterly basis, okay, this sector of the market is not performing. We're going to move to this one based on the formula rebalancing.
Okay, so the goal in momentum is to own the 12 best performing stocks on the Toronto Stock Exchange in the next quarter.
That's right.
How have we done?
Right.
Have we got 7 in the last quarter? 8? Do you know?
The last quarter, I think we got, so we have 12. I think we got 6. I think we got half.
I think so too.
Yeah.
Yeah.
Mm-hmm.
And the quarter before that, if
Which
I
is
remember
great.
right, was 8. You may not remember
Yeah,
that.
I believe you're right.
Yeah.
I don't remember, but.
And then the other
right.
6, they were just dogs, right?
Well, you know what? I don't know if they were dogs. Some might have been, but they weren't necessarily the worst. Not all of them. They can't all be the worst,
No.
right? So
I'm joking. Yeah. I think we had 6 in the top 12, 4 in the next 8, and then 2 that were lower down in the TSX 60.
Mm-hmm.
Yeah.
Mm-hmm.
Okay, I think we're done, Tarek. Is there more that you wanted to say? Anything else I should say?
No, I think that covers it. I do want to, I guess, emphasize, one question that I think we need to answer is, okay, so the Fed's going to continue to increase rates. Things are still going to continue to be difficult. Should I go to cash? What should I be doing? And I do think it's important that we emphasize it is not the time to go to cash. It is not like you were saying at the beginning, Mark, it is very, very difficult to time the market, and don't try to do it. There's people who are sitting at their computers for 12 to 16 hours a day trying to time markets, and they can't get it right, and they won't get it right. So stay invested. I know it's hard when your portfolio is down, but when we set up your portfolios, you told us your goals, you told us your objectives, and they were long-term, and this too shall pass.
On that
Do you have
subject,
anything to?
it's a good point. Yeah, I like that point. I was looking at some 5 and 10-year charts today. In fact, you and I were talking about this today, and looking at some 5 and 10-year. Even with this pullback in the market right now, you wouldn't mind being in this market if you put your money in 5 years ago. And especially you wouldn't mind if you put your money in 10 years ago. I'm sure 10 years from now and 5 years from now, we'll be feeling the same way. Wow, it's just been a really good time. The other thing on a technical basis, and you should believe Tarek and I are fundamental in our nature and quantitative. I'm very much a quant in my approach to investing, and Tarek is as well. But the technical analysts are looking at today's market saying, hey, this is a double bottom. And what they're doing is they're looking at a pullback that came in July, I think it was. Then it ran a little bit, and then it came back to this same level. And what they'll be watching is, does this break down from this double bottom, or does it bounce off of it? Based on yesterday and today, it looks like it'll probably bounce off of it. A double bottom is a very strong foundation for the market to grow. So where will it go? Well, TSX is what I'm talking about. It peaked at about 2,200, and today it's about 18,300 or 18,500. It was 22. What they'll say is it will likely go back to that 22, break through it, and go just as far above the 22 as we are below it now. So it's like a 3,000 point bounce to get back up to 22, 18.5 to 22, add another 3,000, and that's where technical analysts will be saying, we think that's where the market is going. When? Not tomorrow. Probably in the next 2 years. A 6,000 point bounce in the next 2 years would be a very welcome thing and totally believable. So that's a little bit of sort of stepping back and looking at it from a different perspective.